Okay, so here we are with the 7-2 work together. And on this one, we're going to calculate the balance sheet with owner's equity. So just like the income statement, our first step is going to be to create a header. So it says in the directions, all pro painters has completed its worksheet and income statement is now ready to prepare the balance sheet. The first step in preparing a balance sheet is the heading. Fill in the blanks for each row of the balance sheet heading for all pro painters for April 30th of the current year. Enter the current year as 20-. So all pro painters This is going to be the statement. Balance sheet. In April 30th, 20-. So there's the heading for the balance sheet. So we'll go to the next step. And just like on 7-1, we're going to identify the accounts that are going to go on the balance sheet. What it says here, balance sheet. So we're going to determine whether this is going to be an asset or a liability, owner's equity, or neither. So cash, hopefully, those from all the other worksheets that we've done so far, that this has stuck with you, that cash is an asset, anything of value that the company owns. Petty cash is an asset. The accounts receivable is an asset. Another accounts receivable is an asset. Supplies is an asset. Prepaid insurance is an asset. Then we get to accounts payable. So any bills that are owed, those are a liability. So the accounts payable are bills that are owed, so that's a liability. Another accounts payable, liability. Then we've got the capital account. So that's going to go in as owner's equity. And if you happen to be looking at the balance sheet example in the book, so the drawing account is not going to go on there, so we'll count that as a neither. So remember, it says in the instructions, for any account that does not appear on the balance sheet, select neither. Even though technically the drawing can be under that umbrella of owner's equity, it's not going to be on the balance sheet. Income summary is not going to be on the balance sheet. Then we've got the rest of these sales through expenses. Those were on the income statement, so those do not go on the balance sheet, so we'll put neither in all of those. So now we'll go to the next step. Here's the worksheet for all pro painters. So we're going to get the information from the worksheet and fill in these boxes. So we need the amount from Dwight's capital account on April 1st. Let's find the capital account. So here's the capital account. Like I said, this beginning April 1st, $3,500. Remember when we did the worksheet, and one of the things I mentioned was that the trial balance, another way to kind of think of this is at the beginning of the month balance, and then any of the changes that happen to the accounts during the month go in the middle two sections, and then the balance sheet or the balance for the accounts at the end of the month. So April 1st, $3,500 for capital. The net income, that is down here at the bottom, 3730. 3730 is the net income. So 3730. And then we have the drawing account. So that's the money that Dwight took out of the business. So the net income is the money that was left over after the expenses. But remember, Dwight also took some money out. So let's get the drawing. So here's the drawing account. So Dwight took out $1,200 during the month. So what we need to do for these two accounts, for this other box here, is we need to subtract the amount of money that Dwight took out of the business during the month. Because already took that money out. So we need to take that money out to show what the total capital left is, or that total owner's equity is at the end of the month. So $3,730 minus $1,200 leaves $2,530. So then the total for the capital account at the end of the month is going to be the $2,530 plus what he started the month with. So the total capital account value at the end of April is $6,030. So basically, Dwight started the month out with $3,500 in capital value. Then the business brought in an additional $3,730 as income, as left over after the expenses. So $3,730 during the month is income. But then also during the month, Dwight took out $1,200 to spend on personal use stuff. So we need to subtract that out. And then everything that's left over, $6,030. So there's the statement of owner's equity. Okay, so let's go to the next step. Now we're going to fill in our balance sheet amounts. So we're going to get that from our worksheet. We've got our balance sheet columns here at the end. So we're going to fill these in. So we've got cash and petty cash. So cash is $47.50. Petty cash is $75. The accounts receivable for Mackerman, for G, $825. The accounts receivable for Woo, that's $715. We have the value for supplies, $110 in supplies, and $320 in prepaid insurance. $320 for insurance. Now we're going to get our liabilities. So let's see how much we owe, or how much Dwight owes to Belmont Supplies. Here's Belmont Supplies. Dwight owes Belmont $275. And Dwight owes Lurgent, the accounts payable for Lurgent Paints, $490. Now here's a little bit of a curveball. So here for it says the capital account. We are not going to use the amount that's on the balance sheet. We're going to use the amount that we just calculated in the previous step. Because remember, on that previous step, we took into account the net income for the month, how much money, how much value the capital account was at the beginning of the month, plus we deducted the money that Dwight took out during the month. So in the previous step, Dwight's capital account amount was worth $6,030. And if you need to, you can click on the tab for step 3 to look at that again. Okay. All right, so let's go to the last step, the balance sheet totals. So we're going to total up the assets. This gets us back to our basic chapter 1. Assets equals liabilities plus owner's equity. So in the debit column, we have all of the assets for all pro painters. So let's add all of those up. $47.50 plus 75 plus 825 plus 715 plus 110 plus 320. So all the assets equal $67.95. Now we'll look at owner's equity and liabilities. Add those up. 275 plus 490 plus 6030. 67.95. It's like magic. They both balance out. They both are equal. So that's that. Like I said, the basic foundation of accounting: assets equal liabilities plus owner's equity. So that is the 7-2 work together.